I took a look at multifamily against the S&P since 1990 until about 2020. And I've actually found that multifamily is 58% less volatile than the S&P 500. It's just consistent returns. There's no wild fluctuations up or down. You're not going to see the big years like we saw last year with the S&P, but you're going to see consistent returns overall. And so it allows me to sleep better at night knowing that my account balance is always there whenever I really want to tap into the overall value.
If you're watching this on YouTube, make sure you smash that like button and click subscribe. For those of you listening on a podcast platform, be sure to subscribe on whatever platform that is and leave us a rating if you can. The more likes, ratings, and subscriptions that we get, the more we can spread the message and grow our community. So we also have a free Facebook group. It's called the Average Joe Finances Network. Check us out, join the group, join the community, ask questions, and become a part of the team. All of our other social media accounts are listed in our flow page, and we have them in the video or podcast description below.
All right. Hey, how's it going, everybody? So today we have on with us Josh Plave, and Josh is a multifamily syndicator that specializes in helping investors use their retirement funds to passively invest. Through his company, Walden, Maine, Josh provides all the tips and tricks needed to invest quickly, safely, and inexpensively with existing retirement accounts. So, hey, Josh, absolute pleasure having you on the show. Thanks for talking with me today.
Thank you so much for having me.
All right, awesome. So, hey, first things first, same question I like to ask everybody when we kick things off, because maybe people don't know about you. So if you could just share a little bit about your story, tell us about yourself.
Yeah, absolutely. For those of you not watching on video, I'm only 30 years old and I'm talking about retirement accounts. So I tend to get people asking me, what the hell do you know about retirement accounts at that age? So I've actually been doing this since I was 16 years old. I opened my first Roth IRA after I was a camp counselor for the summer. And so my mother and my grandfather, who were both CPAs, they suggested that I start looking out for the future and start investing. That's sort of where I got the bug. I started being interested in looking out for my future, not just from a retirement perspective, but just making sure that my money is making money for me. So I started investing in equities at that age. Skip forward about 10 years from then. And unfortunately, as I mentioned, my mother and my grandfather, they actually both passed away. And so what that did was they were kind enough to leave my sisters and I with their retirement accounts. It wasn't a life-changing amount of money, but it was enough that I needed to make sure I was going to be a good steward of everything that they were worked for their whole life, make sure I was going to preserve it. And make sure that I wasn't just taking everything and putting it on the first shiny object that I thought looked really cool, like a nice investment. So it was around this time that I was actually wanting to move out of equities, into something that's a bit more stable, something that I could control a bit more. And we can touch on that later. But that's really the main reason I wanted to shift a lot of my own personal investments, as well as the ones that I had inherited, over to real estate. And so I ended up jumping in. I had a W-2 at the time, so I was able to kind of take a step back and go at it from a more pragmatic, slower standpoint. And so I was able to start with what I eventually wanted to accomplish. And that's why I started with multifamily, and I'm still doing that to this day.
Right on. Yeah. So you got started at a young age at 16. There was something that you said there that I really liked. And I think it's a kind of a key phrase that I want to point out is, and sorry for your loss, but when you were talking about how, when you lost your mother and your grandmother, they left you, some money from their account, from their retirement account. And, the thing you said is, it wasn't a life-changing amount, but the big thing is you wanted to be a good steward of that gift that was left for you. And I think that's one of the big things people need to take back with them is like, hey, be a good steward, of your money, or if any money was given to you for anything, but not only that, but just, your own accounts and your own retirement accounts, just be a good steward with what you're doing. So yeah, awesome stuff, man. So there's a couple different topics I want to talk about with you today. And, but before we get started on that, I just want to ask you something about you yourself personally. What are you doing on your journey to or in financial freedom right now?
Currently, right now, we are, as we speak, we're under contract on 2 deals, possibly by the time it airs or whatever in the next few weeks, it's going to close. So I'm essentially, going out with my partners. We're finding different syndicated deals around the country, looking for larger multifamily properties in the 90 to 250 unit range. And we're just looking to find some value add properties. We're not reinventing the wheel. We're just finding things that suit our investment profile and what we're looking for our specific investors.
Right on. And how long have you been doing this?
This will be my 4th year. I've been doing it for 3 and change.
Okay, awesome. And what do you enjoy about it?
I love the control. Honestly, what I really enjoy about multifamily particularly is the fact that you're not necessarily investing in or buying a piece of real estate. It's almost a misnomer. You're really investing in a business. You're running a business that happens to own real estate. You're relying on people and the operators to execute a business plan and to make sure that they're using their skills and their talents to work out the business plan in the way that they plan for. It's not just dependent on making sure that you're buying a property that has good comps nearby. It's not small single family homes because you can get hit with a bad comp on a single family home. I love the fact that multifamily is based on what you control and how you can do it. And so I can sleep a lot better at night because I have all that control, knowing that we're executing properly.
Right on. So control's the name of the game. So one of the other questions I like to ask is what kind of asset classes do you currently invest in? So I know you're doing multifamily syndications. Is there anything else that you're putting your assets into, or other assets that you're investing into?
Yeah, I mean, while I have some downtime in between multifamily deals, and while I was starting up multifamily, I do some private money lending opportunities as well, where I lend to, different flip operators. But I'm also doing a little bit less of that right now, A, because I want to get more into multifamily, and B, just because I think the timing is not the best surrounding pandemic. But other than that, no, multifamily, primarily, as I mentioned, 90 to 250 units. We're looking at primarily B and C assets. But we look at like A- or something like that we reposition potentially. Stuff that's value add, garden level style properties across most of the Southeast, essentially.
Okay, right on. And that's pretty neat though that you said like on some of your downtime you've done some private lending. The person I interviewed last week and that one will probably air maybe a week before yours comes out. Does private lending, like strictly private lending. So that's pretty cool to hear somebody else doing that as well. Okay, so I want to talk about some of the topics that you wanted to discuss, right? So we were going to talk about some multifamily real estate investing, some self-directed retirement accounts, checkbook control, IRA taxes and their impact on how to minimize the effects, establishing passive income to replace your own salary, which that's what everybody wants to do, right? Managing an inheritance and the importance of starting your investing journey early. And you definitely started early. You started at the age of 16. So I want to ask you, how did you do that? How did you start at 16?
Yeah, I mean, I basically contributed what I had earned that summer as a camp counselor, as I mentioned. It wasn't a lot. I think it was $1,000. I invested in what I knew at the time. I was obsessed with airplanes. I was in the middle of getting my pilot's license at the time, and I bought I think it was an aerospace and defense fund against the better judgment of the broker. He said, don't do it at all. But I invested in what I knew, and it actually beat the S&P 500 for the next 15 years. So pretty happy about that. But, just continued to essentially, I learned at a young age that you need to focus on compounding growth. And so I just continued to contribute every single year. And now the account is worth well over $100,000. At a young age. And that's just through IRA contributions. That's not really through large 401k rollovers into it. So I'm pretty happy with the growth that it's seen. And it's been important to start at a young age as a result.
Right on. So we kind of already touched on the multifamily investing. So I want to kind of switch gears here and start off with a self-directed IRA. So if you could, can you tell me what a self-directed IRA is?
Yeah. It's just kind of an odd label that people have put on it. It's just the same as any other kind of IRA. All retirement accounts, whether they're IRAs, 401ks, 403bs, thrift savings plans, TSPs, anything, they all can be invested in virtually anything you like. It's not just limited to stocks and bonds like many people believe. You can invest in alternate asset classes like real estate. You can do gold, cryptocurrency, all kinds of stuff. I've heard of people even buying racehorses and taking those in their portfolio as well. But
Wow.
There's anything you want.
I've never heard of anybody investing in racehorses through their IRA. That's pretty amazing.
Yeah, it's pretty good. I mean, you're only because you're with a racehorse or anything that can experience large capital gains. It's a great place to put it because you don't have to pay any taxes on those capital gains. So but there really are only 3 restrictions on what you can invest in. You can't invest in collectibles like art, jewelry, cars, alcohol. You can't invest or you can't buy life insurance policies within your retirement account, and you can't own shares of an S corporation. That's about it. Other than that, if you think it's a good investment, you can put it into your IRA, your 401k, anything you want. You just have to move it into a custodian that allows you to. We all mostly have our retirement accounts over at custodians like Schwab, Vanguard, Fidelity, TIAA, places that just don't facilitate alternate asset classes. They're strictly around stocks and bonds. And so you just need to move it over to a custodian that facilitates those.
Right on. Yeah. So it's funny. I was talking to you about this before we started recording, but I literally was just listening to another buddy of mine's podcast, the Chris Miles Money Show, and he just had an episode air talking about self-directed IRAs. And I was like, man, this would be an interesting topic to talk about on my podcast too. And it's funny because I'm looking through your background and everything after everything was scheduled, and I'm like, this is exactly what Josh wants to talk about. This is fantastic. So, so that kind of got me all excited and everything. So you're talking about all the different things that you can invest in with your self-directed IRA, right? And one of them that you mentioned was real estate, right? And that's what a lot of people like to invest in because real estate's a great vehicle for building your net worth, building passive cash flow. So how do you use an existing retirement account to invest in real estate?
It's the kind of thing that once you understand how to do it, it's pretty simple. There's essentially 2 different types of accounts that you can run. There's the custodial account. As I mentioned, you move money from one custodian over to another. It sits at the custodian when you find a deal. You then, you fill out some paperwork. You send it into your custodian. You let them know, hey, I have this deal. Here are all the details. They ask you some questions and they approve it. And that typically takes a good amount of time. There's also the other half where it's called checkbook control. This is what I opt for personally as a passive investor. When I'm using my retirement accounts, checkbook control takes it a step further. So you have a provider also prepare an LLC for the IRA. So you open an LLC. The IRA's the custodian account, its only investment is into this LLC. And then you can open up a bank account just as you would for any other business. You can run the LLC from there. You can manage it yourself. You can essentially, I like to joke, you can find a deal by breakfast and fund it by lunch. It's instantaneous. A lot of the time, the fees associated with it are much lower. They range somewhere between $130 and $180 annually. They don't scale like a custodial account does when your account value grows. So if you are doing a good job investing and you start to make more and more money and the account is worth more, at a custodian account, you would typically start to get charged more. With a checkbook control account, it stays the same. You just end up paying wiring fees every time you have a transaction.
Oh, that's good to know. So yeah, that could be some significant savings by doing it that way. So, all right. So checkbook control, since you mentioned it, how exactly does it work and is it safe?
Let's take a brief moment to hear from our show sponsors. What's going on, Average Joes? We know that managing one account or your entire family's portfolio can be stressful and time consuming. From building and maintaining spreadsheets, calculating how many new shares and units you need to purchase with your contributions, finding the time to log into your brokerage and make those trades, and annually rebalancing each account. Well, my friends over at Passive came up with a tool that can help you manage all of this in a fraction of time without spreadsheets and manual calculations. Passive is a portfolio management tool that makes it easier for DIY investors to maintain a balanced portfolio and build a passive investment strategy at their online broker. It eliminates the need to use spreadsheets, saves you from having to log into your broker to place trades, and helps you stick to your portfolio's target allocation. Elite users can save even more time by using the one-click trades feature and having Passive execute the required trades on your behalf. All of this can be done from the Passive dashboard for all of your accounts. No more logging in to multiple brokerage accounts. Passive is not a robo-advisor. It won't tell you what you should invest in, so you'll need to decide that for yourself, either through self-education or alongside a financial advisor. To learn more about Passive or to sign up, check out our link below, www.averagejoefinances.com/passive. That's PASSIV with no E. Again, PASSIV with no E. Check them out. Hey everybody, how's it going? This is Mike Cav with Average Joe Finances. You know, we're living in some pretty tough times right now, and if you don't have life insurance, you should probably get it. You need to protect yourself, protect your family, and protect what you own. Check out the link below in the show notes or in the video description. Let's get back to today's episode.
Yeah. So checkbook control, the way I kind of went over the way it works. I'm not thinking that I left much of anything out. Like I mentioned, you open it up at a bank and you make sure that you operate from there.
Now, you said you have to open it as an LLC, right?
Yeah.
You're not opening it in your name.
Exactly. So it's the LLC is owned by the IRA or whatever retirement account you're using. And so from there, you're in control. And that's the thing. A lot of people do worry that it's dangerous. It's risky. I typically only suggest checkbook control to people who do the due diligence to understand what they can and can't invest in. There are some rules surrounding it, and you do need to know these rules. But there's a limit to the rules. It's not like there's a million gotchas. You just need to understand the types of transactions you can and can't do. So if you have a good understanding of those, and we can go over some of them, from there, I like to think of it like it's just cash. I just have a different set of rules I need to apply every time I think of a transaction, but it really operates very similarly to cash. You need to make sure that you're abiding by the rules, but from there, it stays pretty clean and simple.
All right. So you're talking about these different rules that you have with checkbook control. So if you're putting the money into the LLC, into the bank account, right, and you want to go invest in some multifamily with it, are there like taxes involved with this? What kind of stuff can you expect tax wise when using your checkbook control with your self-directed retirement account? What kind of stuff can you expect when you're doing it that way?
So to answer this question, there's two different types of retirement accounts that people end up using to invest in real estate. One is a solo 401k where you have your own business, you're earning self-employed income, and you can become not only the employee, but you're also the employer. And so you can sponsor your own 401k and provide, contributions via the employer side and the employee side. The nice thing about this type of account is that it is completely exempt from any kind of tax. But when you use a self-directed IRA, if you're investing in multifamily and that's a leveraged asset, there's this concept we need to understand when investing passively. So if let's say you're buying a property for 75% leverage, 25% equity, 75% leverage, 75% of the dollars that are coming in are actually from an outside source. They're from the bank, from a lender, and they're not tax deferred dollars. Your IRA obviously is going to be tax deferred. And so any income that is earned by the tax deferred dollars on the IRA side, totally tax free. Don't have to worry about that. On the 75% portion, you have to worry about what's called unrelated debt financed income. 75% will earn UDFI because it's outside dollars and they're not tax deferred. They're not associated with a bank or with a retirement account. They need to pay income tax. And so you end up paying tax that is called unrelated business income tax, UBIT. And so a lot of people make their career on scaring people away from the concept and saying UBIT's going to destroy your returns. And so I wanted to go through and kind of answer this. And so for myself, before I even started my business, I ended up creating what I think is the industry's first UBIT calculator. So I can actually go through and I can put a deal through it and figure out what the UBIT impact will end up being to the overall investment returns.
Right on. So, okay. So can we go into a little bit more detail about the unrelated business income tax and unrelated debt financed income? Like maybe just get a little more detail on that, because I have never been familiar with that until I was reading up on your background. And I find it very interesting. I had to do some research on it. I was looking it up, and I think this would probably be something great for our listeners to hear. But can you just go into a little bit more detail about what those are and how it works?
Sure. Yeah. So With unrelated debt financed income, for every dollar that's coming in, they're taking a look at what it's something called the debt financing ratio. And so as you pay down the loan through the life of the deal, they're taking a look at what's the average over the entire year that you're going to be paying taxes. What's the average debt financing ratio for the year? And so if it's 75%, they're applying 75% to the overall income. And that's going to be your unrelated debt financed income portion. As you pay down the debt, the value ends up fluctuating. Then with UBIT, the nice thing is you actually get to use, because you're taxed on 75%, the outside dollars have to be taxed. The outside dollars can actually use depreciation, operating expenses, interest expenses, any kind of loss.
Can I just jump in? Just a question about that. So as the debt's going down, do you see that the UDFI is also lowered, like or what they can tax you on is also lowered?
Yeah.
Okay. I think that's kind of what you were explaining, but I'm sure the gears are turning while you're talking about it. I'm like,
yeah.
So you're starting off at 75%. As you're paying it down, it's getting lower and lower and lower. You're paying less taxes on that.
Exactly.
As you're paying down the debt. Okay. Fantastic.
Right. The ratio at least shifts.
Yeah. Right on.
And it depends really on how much depreciation or losses you're able to carry forward to the next year. And so, with commercial real estate, we have significant losses up front. I should mention that retirement accounts can only use straight line depreciation. So you can use accelerated straight line depreciation like cost segregation, where you're, reallocating from different depreciation length buckets. But you can't use bonus depreciation, anything like that. That doesn't apply. So that just gets lost essentially. But anything that's in excess of what your tax bill is can be rolled over just as you would a normal taxpayer. And so you move that forward and you can help offset your overall income. I've ended up finding through, running my UBIT calculator hundreds of times, I've ended up finding that, the first 3 to 4 years, you're typically not going to experience much of a UBIT penalty. You're looking at $0 to maybe a couple $100. And then the real big bill is on the overall sale and the capital gains. And so you have to pay a larger amount then, but at the same time, you've also been returning, some cash flow in the meantime. And so we see overall that there's about a 4 to 6% annual return impact over the life of a deal. And so if you're looking at maybe, let's say 20% returns over a 5-year hold, it's going to be around a 14 to a 16% return, most likely at the end of the deal.
Okay. But when you're doing it this way, is it possible to 1031 that to try to avoid that tax penalty? Or are you going to wind up paying that regardless because of how you funded it?
It'll be regardless. 1031s don't exist within retirement account space, unfortunately.
Okay.
But what you can essentially do is when you get the funds in, you can reinvest the majority of them into another deal and use that, those losses, those appreciation to help offset your capital gains. And so just as you would sort of as a cash or passive investor, you can continue to use those losses to offset other deals within the same account.
Okay. Right on. All right. So with all of that said, why is multifamily a good fit for retirement accounts using this strategy?
I kind of came to this conclusion after I had talked to my dad for quite a bit. We're trying to plan for his retirement in the next, 6 to 7 years. And we're not really sure when he needs to tap into his 401k, sort of where the market's going to be at that point. And so we want to hedge our bets and make sure that even if the market is down at that point, he won't have to entirely rely on pulling out of his 401k really when the balance isn't there, or he doesn't want to necessarily sell positions within his 401k. And so I love multifamily from a number of perspectives. We've already talked about leveraging your retirement. Not many people know that you can apply leverage in your retirement. But also multifamily is great because it will stabilize your overall portfolio. I took a look at multifamily against the S&P since 1990 until about 2020. And I've actually found that multifamily is 58% less volatile than the S&P 500. It's just consistent returns. There's no wild fluctuations up or down. You're not going to see the big years like we saw last year with the S&P, but you're going to see consistent returns overall. And so it allows me to sleep better at night knowing that my account balance is always there whenever I really want to tap into the overall value.
Right. Yeah. Real estate in general is just, always a pretty safe bet because, people always need a place to lay their heads at night. Regardless of what paper assets are doing in the stock market, right? That, that can fluctuate. I mean, look at what happened, a year ago today. Well, not today, but I guess by the time this airs, it'll be a couple weeks ago, a
Yeah.
year ago. But I mean, when we had that huge drop and then the recovery since then, we've gone above and beyond what we lost. So what a year 2020 has been. Just a roller coaster of emotion, a roller coaster of finances. I mean, some people really made out big. Some people lost a lot. And, it was what you made of it this past year. And one of the things I've noticed is the folks in the real estate space made out pretty good in 2020 because they were able to just keep doing what they were doing regardless of what was going on in the stock market. And then to top it off with the low interest rates that we were able to enjoy this past year was definitely helpful for that as well. And now we're seeing the aftershock of that with this being a seller's market, at least in, single family homes and everything. So yeah, that's a wild roller coaster ride of a year. So much value in this conversation and with what you shared today. I really appreciate it. So I've got one more question I have to ask, and it's probably the most important question of all, because I think with all the golden nuggets that you've given us, people are going to want to get to know you a little bit more and learn a little bit more about you and what Wall to Main is doing. So if you could, please share with us if you have a website or social media.
Yeah, absolutely. My website is wall2main.com. And there I've got all kinds of educational content surrounding this topic, diving, well in depth into passive investing as well as retirement investing. I also offer a free PDF called the Top 10 Tips and Tricks when passively investing in multifamily with your retirement account. And I kind of just run over all the little rules and regulations that you need to follow, but the ways that you can kind of maneuver your account and minimize the overall impact that they have so that you can maximize your account.
That's awesome. One of the things that I love about being in the real estate space since I got started is just the wealth of knowledge that's out there. And most people I meet, they're not afraid to share what they're doing because there's so much out there for everybody. And, the value that you add when you give this information for free, I just want to say thank you. And I'm sure my listeners are going to thank you, but this is good stuff, man. I'll make sure I have all your links in our show notes. And so it'll be easier for people to find you. They can just copy and paste or click and go check out Wall to Main, guys. Josh is doing some pretty cool stuff and really enjoyed having you on today. Thanks for joining us.
Thanks for having me, Mike. I appreciate it.
All right, right on.